today's scenario is for the professional athletes, right? So this is something that I've been very passionate about figuring out after or during my retirement, before my retirement. I was always looking for different strategies and ways that to help us secure our lives financially outside of our basketball career and professional athletics career. For those of you guys who are familiar with overseas athletes or guys who are playing overseas, you understand things that we're kind of pretty much lacking as players. We don't have access to 401ks. It's something that's not offered to us by our employers, IRAs, and other retirement accounts. There is no pension for athletes overseas, right? So unless you're a part of some other organization that I don't know about, or you have some type of tenure in the NBA, typically you don't have a retirement plan that's offered to you. So you have to create one for yourself. There's a few different things that I did when I was a rookie, and uh, it didn't really pan out like I thought it would. But I also wasn't as patient as I probably should have to see it through to the end. But one of the things that I implemented when I first started making my own money overseas as an athlete was I started putting $1,000 each month into an investment account at a company called Edward Jones, and had a financial advisor, and everything was pretty much smooth. I would come home in the summertime and meet with her, and she would show me my gains and what I was placed in as far as the investments, the ETFs, and the stocks that I was investing in. Um, and it went, well for a few years. But after a while, me as an entrepreneur and somebody who loves to invest and loves to try new things, I started seeing it as a slow paced way of me making money. I wasn't looking at it as a retirement account. I was looking at it as an opportunity for me to double my money or make a significant return off of my savings. And that's just not what it was designed for. So as I became more and more educated, I realized that there are some different avenues that you could take in order to accomplish that goal of getting a retirement, or at least having some money there for you in your retirement. So once I went back to school after I retired, I started to become educated and see that there are other options out there that are just not offered to us unless you have some type of financial advisor or a broker or someone who you trust who will suggest these things or educate you about these strategies. So that's my goal. That's what I want to do to help professional athletes, and specifically guys who are overseas who don't have these things offered to them on a day-to-day basis. I want to be a resource for you guys, so you could always reach out to me and get that type of advice and education. All right. So give you a little bit of background about myself. My name is Landon Milbourne. I'm a financial professional. I'm a licensed insurance broker in 8 states currently. I graduated from the University of Maryland in 2010. I went back to school in 2021 after I retired from playing ball overseas for 10 years, played in 7 different countries around the world. And when I went back to Howard University to study specifically financial planning, and insurance planning is definitely one of the modules that we had to study. Huge, thick book. Spent a lot of time uh, understanding it and figuring it out. One of the things that I really took a liking to was the Rockefeller waterfall method. I'll post about that on my Instagram page. So go ahead and check that out. But it's a very, very uh, doable and attainable thing for all of us. That's not very costly if you start at the right time. Getting your kids insured at a young age is very cheap. Securing their financial future for 30, 40 years ahead is very doable. It's not that difficult. As long as you have someone who you trust, who has educated and experienced enough to write these type of policies for you, I definitely would take some time to look into it. As far as professional athletes are concerned, you have to look into it because there really isn't that many other options. A lot of us play high risk games. We invest in our friends' ideas. We invest in our own ideas. I personally invested a lot throughout my professional career. And at the end of the day, we know, and especially when it comes to business, most of your business ideas are going to fail. Most of your friends' ideas are going to fail. Some of them will hit, but it may not be enough to really hold you over for the rest of your life. That typically doesn't happen. And for guys who play basketball overseas, we all know that the average career is about 3 to 5 years. So I structure these plans for that time frame. I was blessed enough to have a professional career that lasted about 10 years, but that's not the usual case. But we know you guys are taking care of yourselves. We know you guys want to have longevity. With that longevity comes an opportunity for you to secure your financial future for yourself and your family if you are able to put your money in the right places. So obviously saving is great. For most of us who play basketball overseas, we kind of get into the habit of saving. We start saving at a certain point in the season. We go home and pretty much spend a lot of or all of what we saved, just enjoying our summer, working out, visiting friends, going out, having a good time. But it gets to a point to where you need to have a good nest egg to prepare for your retirement, because you don't know when it's going to come. Whether it's injury, whether it's just you walking out on your own, you don't know when it's going to come. So preparing for that from day one is very important. And the example that I gave was from my experience of putting aside $1,000 a month. If that's doable for you, great. If that's something that's a little bit of a stretch for you, then we can always structure it to where it fits within a budget and it makes sense as far as what you are looking forward to in the future. Right, so here are my licenses, well, a few of them, about 6 of them. As you can see here, I am licensed for health products, life insurance, annuities, as well as employee benefits and helping small business owners as well. And property and casualty, car insurance, home insurance, personal liability insurance, pretty much any type of insurance that there is to educate people on and sell, I'm licensed to do so. All right. So another thing that I focused on as far as helping my clients, I help them with life, health, and wealth strategies. And the one specifically that we're going to speak about today is an index universal life policy. Right. I am partnered with multiple insurance carriers, 30 plus A-rated carriers. Make sure that I always go and get the best policy for the best price and for the right person. Everyone has a different situation. Everyone has a different purpose for insurance. Some people want to take care of burial expenses. Some people want to take care of mortgage protection. Some people want to take care of retirement planning and get a gain on their cash value. Whatever the case may be, I'm able to help you out. All right. There are 3 types of insurance that I focus on. Term insurance, again, is very popular because it's cheap and you get a lot of money in return. But typically, most people outlive those policies. They are temporary. So a lot of times you don't end up getting the benefit that you signed up for that look very attractive. But there are plans that do give you return of premium. So all of your money is not wasted. We are able to do that for you as well. Whole life policies is something that a lot of our clients are very privy to and take part in because it's permanent, right? So you may have insurance through your job, which would probably be a term policy. It's always best to have a whole life policy in place because it gives you lifetime coverage, and the premiums are level, so you know what you're paying each month. It does not fluctuate, and it builds cash value. So there is a savings component to it, and depending on what company you go with, there is an interest attached to it. So you are able to get compound interest over time. Another example or the other type of insurance that I am able to educate on is universal insurance, which is also permanent. And this is the type of policy that we're going to be discussing in this example, right? So go back to this. So one of the things that we do have to focus on for sure is why do we need this protection? What are we protecting, right? In this particular case, we're protecting income because we understand that once we get to our 60s, obviously we're not going to be getting any money from basketball. And depending on our career that we choose, we might be on the verge of retirement or going into retirement as well. So you're going to have a loss of income. So this specific strategy is dedicated towards helping you get some type of income during your retirement years, right? Late retirement years. Also, how long will we need this coverage? How long will we need this income, right? This specific strategy, I organize it to where it could pay you for 25 years straight. All right. And then what is your budget? That depends on, what you're bringing in as far as salary or what the team is paying you. Some of you guys might have other streams of income, which you definitely should if you can. Go explore some of those opportunities. I would advise you to do so. And what's comfortable for you, right? We don't want to put anyone in a situation where you feel like it's straining you or stressing you financially each month, because that'll put you on the verge of cutting it off, and it'll lapse, and you're not going to get the full benefit of what you signed up for. So we want to make sure we put you in something that is affordable, that's not going to burn you up financially, right? And then what benefits does this actual policy provide for you? Number one, it's a wealth transfer. There is a death benefit, all right, in this particular policy. That's $769,592. Okay, this is for a 23-year-old male, non-smoker, preparing to leave college to go overseas and sign his first contract, right? I use this example because if I had this in front of me when I was graduating college, I would have definitely done this. And because of the way I structured it, it would have been so easy to do that I wouldn't even have been thinking about it. Because the $1,000 was going to get spent regardless if it was going to be saved or not. That's just the reality of the situation. And now that I'm out of the game for about 5 years, I look back and see all the money that I had a chance to save. Now, 5 years removed, there's literally, if there's nothing tangible that you purchased or an investment that you were able to take part in while you were playing basketball, 3 to 5 years after retirement, most athletes are going to be bankrupt, divorced, right, and depressed. Those are statistical facts. And when it comes to my specific situation, 5 years removed from being retired from basketball, there is nothing that is tangible that I was able to take part in that remains to this day that's actually providing income for me. Everything that I did that provides income for me came after basketball. So that's a new career that you have to start after your old career. And whatever career you decide to go into, you have to start from scratch. So the new situation might provide a 401k. The new situation might provide a pension or something that gives you a little bit more stability in retirement. Basketball did not. So if you weren't able to buy a house, or you weren't able to partake in some type of business adventure that became very profitable, or you weren't able to save a majority of your money and is sitting there and gaining interest in some other vehicle, then typically you walk away with pretty much nothing, and you don't have anything tangible to show for it other than some trophies or a ring. Hopefully, if you were successful and winning while you were playing, right? So other than that, there's no other security there for you financially unless you can sell some of the memorabilia. So for me, this is not the end all be all. It is a strategy that you can use that I suggest you should use. If I would have known about it, I would have used it. But now I'm participating and playing catch up, right? And that's just the way it goes for me. But my goal is to make sure that I touch guys or reach guys that are going into the pros and may not have any options at that point. This is something that you might be able to look into. Get with your financial advisor, contact me. I can give you a demonstration. I can give you an illustration to show you what is possible, and I can answer any questions that you may have as well. All right, so the other advantage is cash value. Obviously, this is a savings vehicle. So part of the premium that you pay each month is going to go into the cash value account, and that is going to gain interest over time. And the interest that you gain is going to be taxed. The benefit is not going to be taxed. The money that you put into the policy is not going to be taxed. All right, only the gains. Okay. And it also gives you living benefits, right? So accelerated death benefits, critical illness, chronic illness, terminal illness. Any of these things get triggered, you're able to access the death benefit before you actually pass away. And these are living benefits, as well as accessing the cash value that you can borrow against and withdraw, right? And then there are other riders that are attached as well to protect your policy from lapsing. There is lapse protection on there. We'll go through that in a second. Term riders, if you have a child, you can add a child term rider to it as well, and get your whole family kind of insured these are things that you can do with this type of policy. All right, so why would you want to even partake in this policy? What's the point? Well, obviously, we want to make sure that we do something to secure ourselves financially while we go into retirement. But another reason is because you want to be able to take advantage of the stock market, right? People get rich off the stock market. People are wealthy because of their investments in the stock market. People are able to survive off of the returns that they make from the stock market. So you want to be able to participate in it. I believe in it, right? So we can look at the 20-year period here and see that on any given year, the stock market could be up 12.89%, 18.29%, 24%, 27%, 25%, right? 21% just last year. This can happen, but also you can have a year where it's a 39% decline or a 17% decline like 2 years ago, right? Are you able to recover from that? Well, depending on your age, you may not have time to recover from that. If you have one negative year in the stock market, it's going to take you multiple years to get back to where you were. And then you have to make a gain on top of that. So some of us who are in our 60s or our 70s might not want to participate in a vehicle like this, because if you do have a negative year, that's almost like a year wasted. You want to go into something that's a little bit more guaranteed with a fixed return. But in this case, it's a variable return. So it can be anywhere between 12,000, which is the cap, and all the way down to 0.25, which is the floor. The 0.25% floor is very important because when years come and the stock market has a 39% decline or a 4% decline or a 17% decline like it was 2 years ago, you still make 0.25% as the floor. That is the minimum. Never go below that, right? And you'll never go above 12%, which is the participation cap for the S&P 500. So this means that every dollar that you put into your cash value account is getting a 100% participation in the S&P 500 index. So if you go into your Robinhood account or your TD Ameritrade account and you look up the S&P 500 index, you could look up SPY, you could look up SPX, and you can see it from a day-to-day basis when it's up and down. You can see it from a month-to-month basis. You can see it from a year-to-year basis. You can look at that, and then you can determine how much interest you're getting in your cash account, literally month to month, year to year in real time. If you wanted to be that hands-on with it, that's essentially what you're doing. I like this policy because I like looking at the market. I look at the market every day. So when I'm looking at the market from daily, weekly, monthly, yearly perspective, I'm seeing how much I'm getting in return, how much my daughter's getting, how much my little cousin's getting, how much my nephew's getting. All the people who are participating in this type of product are able to see, okay, worst case scenario, I'm still going to get 0.25% when my guy up the street is crying about him losing 25% in a year and he's about to retire, right? So that's what is beneficial about this policy. And the scenarios that I'm going to give you or illustrations that I'm going to show you are based on non-guaranteed returns, right? But what you want to look at is a 20-year period. In a 20-year period, the individuals who participated in this, let me make sure you guys can see this. All right, I want to get my laser pointer out. So the folks who participated in the S&P 500 annual point-to-point 100% participation with 12% cap, which means that you are participating in the S&P 500 index 100%, and there's a cap of 12%. Can't get any more than 12%. For the folks who invested in this over a 20-year period, on average, they made 8.08%. The examples that I'm going to give you are a little less than 8.08%, just to be conservative. But you can pretty much bank on the stock market averaging at least 10 to 7%. And for the folks who participated in this particular policy, they were able to get at least 7%, right? But obviously we can get 8 to 12. All right, so what we're looking at is $1,000 a month investment for 5 years only. Remember, the average career span of an athlete is 3 to 5 years. So you have a 5-year period where you're paying $1,000 a month. Now, again, if this is something that's a little bit of a stretch for you, then we can adjust this policy. This is just an example. But for a lot of the folks who I played with, who I played against, who I went to college with, who had good careers, long careers, short careers, we were all at a place where we could put $1,000 aside a month, right? And if you're in a situation where you can't do that, again, we can restructure this to where it makes sense for you. And we'll just look at what potential gains you can get and where you'll be standing when you get to retirement years, traditional retirement years, right? So let's just say you have a 5-year career and you retire at age 29, which is, highly likely, right? When you retire, you will have accumulated, hypothetically, about $59,958 in cash value, right? What does that mean? That means that you can access those funds, borrow against it, withdraw however you decide to do it. I would suggest borrowing against it, right, to keep the policy in place and not take away from the death benefit. You've also increased the death benefit, right, because the interest that was gaining on your cash value has put you in a position where it's going to add to your death benefit. So now you have the cash value plus the original death benefit will put you at around $822,727 in death benefit. What does that mean? That means if you were to pass away at year 5, your beneficiaries are going to get the full amount tax-free. So $822,727 goes towards your beneficiary. That's almost $1 million, right? Now, you're going to continue to live. You're going to continue to move about and go into a new career. You don't have to invest any more money into this policy. You don't have to pay any more premiums into this policy after year 5. It's going to accumulate and gain compound interest over the course of another 20 or so years until you get to, another 30 to 40 years until you get to age 65. Is going to be accumulating and gaining interest. Now, again, going back to the stock market, it's an average 8 to 10% that the stock market is going to gain within a year's period of time, over a 20-year period of time. So you can pretty much bank on you receiving around 7 to 8% each year in compound interest. As that amount grows each year, there's going to be more interest that's going to be contributed to this account each year. Again, you have access to this money. This is not something that you don't have access to. You can borrow against it and you can withdraw. This is your money. This is your account. And you don't need permission to get access to it, right? You just need to make a phone call. Now, once that 5-year period is complete and you are going through the accumulation phase where your cash value is building compound interest, which is one of the wonders of the world, my man Warren Buffett, you get to the years where you're actually retiring from your second career, whatever that might be. And fortunately for you, you were probably able to contribute to another retirement account of some sort, maybe a 401k, maybe a pension, maybe something, right? Obviously, we're going to make up for lost time and potentially be eligible for Social Security if you were able to participate for the hours that are required, right? So we have other options. Again, this is not the end all be all, but it is something that you want to make sure you walk away with, at least from having a 3 to 5, maybe 10-year career playing ball overseas. You got to walk away with something. Yeah, you can save a lot of money, but if your money is just sitting in the bank, it's not gaining any interest. It's definitely not gaining 7% a year, for sure. It's not. And if you really don't know how to invest and get involved in the market and be hands-on with that, then you're not going to see any returns off of that either. You might end up losing. If you don't have any financial advisors who you trust, who will put your money in the right place and not tamper with it, then you won't have that option either. And we see horror stories about that all the time, specifically with athletes putting their money in the hands of a financial advisor, and the financial advisor does them dirty, right? This particular method is not a personal managed situation. There is no financial advisor attached to this. This is a company, this is a contract. You guys are used to dealing with contracts. You guys are used to dealing with a certain amount of money being signed upon and then received, right? Obviously, we have different situations overseas where that doesn't always pan out. I went through it myself. But when it comes to life insurance, do the research, and you can see that life insurance is more safer and guaranteed than putting your money in the bank or just blindly investing it in the stock market or ETF. Because again, you will have years where there is going to be a negative return in the stock market. So this is a safe vehicle where you know you're going to get a minimum return and a maximum potential. You're going to get the gains of the stock market, and you're not going to take any of the losses. So now when you get to year 66, you see you start receiving your income now. This is $4,297.25 a month for 25 years straight. When you turn 66 years old and you start to receive that passive income, something that you set yourself up for back when you was 23 years old, now you're seeing the benefits of it in your future, which might not be important to you right now, but trust me when I tell you, I sit with hundreds of people who are going into retirement and who are in the middle of retirement who did not properly prepare when they were getting money. They put some money in the 401k, but it wasn't enough. They put some money in the stock market, but they didn't know what they were doing. They saved some money into a CD or a bank or regular bank account, thought they was going to get more in return than what they actually did. Now they don't have any other earnings coming in outside of Social Security, and all they can do is liquidate whatever savings they have just to survive. You don't want to be in the same situation, especially if you just got done traveling the world when you was in your 20s. You want to walk away with something secure that you could look forward to in the future. And this is one of the vehicles that will allow you to do that. So now you're receiving this passive income, and it's a load off of your shoulders because it's something that you already worked for decades ago, right? And now you're receiving the benefits from it. Also, keep in mind, when you are getting paid out on a yearly basis, the death benefit remains. All right. Yes, it is starting to get lower and lower, but not that much. So let's just say, for instance, something happens to you when you're 73 years old. At that point, you have already collected almost $350,000 of interest and gains off of the cash value that you started back when you was 23 years old. And if something happens to you, the benefit is $483,151 going straight to your beneficiaries tax-free. And you still have a large amount of money that will allow you can borrow against it. You can take withdrawals. That's there. That's for you. That's yours. Right? So passive income for 25 years straight. You're going to get income until you're 90 years old. And as you can see, by the time you get 90 years old and that last payment comes in, you still have over $120,000 in the death benefit. So you don't have to go shopping for insurance and all that. You already insured. You're good for the rest of your life. Your family's taken care of. And another thing about this policy, I didn't add this illustration to it, but since you stopped taking withdrawals, since you stopped receiving income, now you're given the cash value time to start accumulating again because you're no longer taking money in. Let's say you are healthy enough to live until 100 years old. There are a lot of people that are living to 100 years old, right? Athletes, you guys are going to stay active. You're going to continue to sweat. You're going to continue to keep your weight down. You can definitely live to 100-something years old. This policy is going to insure you to 121 years old. So because you stopped taking income payments at 90, now the cash value is going to go and start accumulating again. And as you see, the cash value starts to go up again, right? And, if I were to continue that, you would see that cash value will continue to go all the way up until the policy expires at age 121. Now, the other important thing about this is how it's treated tax-wise. Remember, you're only gonna get, there's only interest on the gains, right? So the gains are the only thing that's gonna be taxed. The death benefit is tax-free, and the amount of cash value that you put in is tax-free. The gains is the only thing that's gonna be taxed. Also, I showed you an example of an individual putting $1,000 a month into this policy. But you can put more into this policy without triggering a MEC, which is a modified endowment contract. This is pretty much how the IRS keeps people in check from using these specific types of policies as a way to avoid taxes or evade taxes, right? So we don't want to play that game. So all you need to do is make sure that you don't go above the 7-pay amount, which is $37,749.72 a year. Now, again, all of us are not going to be blessed enough to get huge contracts overseas, but I know some individuals who I play with and who are, in my circle, who are friends. They'll spend $37,000 in a year on nothing. A few nights in the club, a couple vacations, a couple trips to the Louis store or the Gucci store. $37,000 is not a lot of money for someone that's making 300,000 or 3 million. It's just not a lot. So to think about how much you could have put into a policy like this and how much you could be getting paid or looking forward to get paid in your retirement years, it hurts when you look back at it. You know what I mean? I personally have been mentally drained just thinking about all the money that was spent on nothing that could have been put into a vehicle like this that would have had me in a better situation. Now, why are you worried about what's going to happen when you get to 65 years old, right? If you're retiring at 29 or 30, 32, like I did, or 31, I guess, whatever it was. Why do I care about what's going to happen 30 something years from now? I need money right now, right? Well, this vehicle is designed for you to receive an income. If you are in a specific, if you're in a situation where you need access to those funds because things aren't looking good for you, things are moving a little bit too slow, the opportunity didn't go through the way you wanted it to, a couple bad investments, whatever the case may be. Again, you built up the cash value. So if you do need to access those funds, you can access those funds. It's not like the income strategy there is something that you have to do. It's available to you if you participate in the example the way that I explained it. If there's an emergency situation and you need to get access to these funds, they're there for you. Also, if you look at the amount that you put in, you're only going to put in $60,000 over the course of 5 years, right? By the time you get to 33 years old, the money that has been accumulated is going to supersede the 60,000 that you initially put in. Everything after year 10 of holding this policy is all profit now. So everything that's in the cash value part of your policy, everything over $60,000 is all profit. And it's just the stairs. It just goes up. It doesn't go down until you start to receive those incomes. So again, I meet with a lot of people who are in their retirement years and they wish they would have conditioned themselves to be in a good place and physically, financially fit during these later years of their life. Unfortunately, it just didn't work out. They weren't privy to the information. They didn't have the right advisors, and they have to make do with what they have. But you're fortunate enough to have options. This is just one option. All right. So how do we move forward with this? For me, I'm just gonna go and look at some options for you and find the right structure for your specific situation. You might want to participate in something like this for 10 years, not 5, right? You might want $10,000 in income, not 4, right? It depends on what you want and what you are able to handle financially as far as premium from month to month or year to year. It's not tied to monthly either. You can do it once a year, right? Some of us get bonuses when we make it to the playoffs or when we win a championship. You get a bonus instead of throwing it away, burning it outside. Boom, you put it into the policy. It speeds up the cash value that you have in there, and it also speeds up that compound interest that you're wanting to gain, right? So we're looking for the right protection, and we're looking for something that fits inside your budget. If it's something that I present that's outside of your budget, let me know. I can make the adjustment. All right. And again, you can reach out to me if you want, some one-on-one time. We can go through some scenarios, and if anything, you could walk away with some illustrations for you and your loved ones to think about. And also there's opportunities for you to go small, right? You don't have to start out with 1,000. Maybe it's something that you work your way up to. Maybe that is your 7 pay maximum that you put in on a month-to-month basis, right? So we can definitely structure it for you. Make sure you reach out to me. Again, you can contact me directly by phone, 404-490-3714. And you can also contact me via email at borncapitalgroup@gmail.com. Catch me on LinkedIn. You can catch me on Instagram. Catch me on Twitter or X, right? And just so you guys know, all of the scenarios that I presented were hypothetical. Nothing is guaranteed, right? But we want to make sure that we look at the company itself, the financial stability of the company that we're doing business with, and make sure that we're properly educated on the product that we're going to participate in. I hold myself to the highest level of personal and professional integrity and promise only to recommend insurance product solutions that are in your best interest. All right. So if you got any questions, make sure you reach out. I'll be available. And other than that, have a good evening.